Well. Welcome back to the Pilot Money Guys podcast, Flight 59. This is the podcast where we tip our caps to our listeners or listener, talk about slipping the surly bonds of Earth. For those of you who are not versed in John Gillespie McGee Jr., that means we talk about flying and then aim to enlighten you with a financial fun topic in a fun-loving way. I'm your host, wealth manager, and major airline pilot, Robert the Rubber Mallet Eklund, and I am of course joined by leading edge financial planning co-founder, former F-16 fighter pilot, and our hero, Charlie the Godfather Mattingly. Welcome, Godfather.
Thank you, man. I need those introductions. My confidence is low, and you always lift me up. So thank you for those encouraging, although not totally true words sometimes. Thank you very much.
Nah, my pleasure. My pleasure. And today we have an augmented crew, and we're joined by newly minted leading edge financial planner. And Nolan, are you a CFP yet, or you're about to be any day, I think, right?
About to be, well, November. So I'm studying for right now. So one day you'll be able to put those behind.
Yes. Soon to be certified financial planner, Nolan the Prodigy Clark. Welcome, Prodigy. That's your call sign. Just sprung it on you and Charlie, Godfather.
Quick and easy. I like it. It fits. Yeah. I can't argue with it.
There we go. Thanks, Rob.
Nolan, Prodigy, tell us a little bit about yourself. Where are you coming from?
I'm in Owensboro, Kentucky, as we speak right now. So this is it's my hometown. This is where I moved back after college. I went to Western Kentucky University. So as Rob said, studying for the CFP exam in November. Joined the team back in February as an intern, came on as full-time, and happy to be on the show.
Excited to have you on your maiden voyage here, Flight 59, talking all kinds of exciting stuff, long-term care, of course. But first, aviation news. Charlie, what do you have on aviation news?
Man, a lot. I think I just paid attention this week. Either that or it was a busy week in airline news, but notification from a friend today that the potential airline retirement age might be changing.
It was just the transportation infrastructure voted 32-31 to include the measure in the proposed legislation to reauthorize the FAA programs for 5 years. And I guess the Senate's got another one that's doing similar stuff. Supposedly. I hope not. I'm not a big fan.
But I know, and I think the point that is most important here is that the Senate has not voted on it. In fact, it's not even in the bill currently. The age 67 rule change is not even in their version of the House bill.
Yeah.
They could put it in there, obviously, but nonetheless, seems like we still got a little ways to go before that happens. But you never know. These things happen. Sometimes all of a sudden, boom, it's done. And like it was in the age 60, 65. So we'll see.
Yeah. And of course, we don't give our opinions that often on this, but my opinion on that, I can't resist, Charlie, is
do it.
I have no problem with the age raising to 67 because I think it should probably be something more medically looked at as opposed to age-based. The optics from my perspective is terrible, especially when all of us are negotiating contracts. So if it raises to 67, obviously that would give perhaps the company some kind of power because maybe there's not as much of a shortage, although that's obviously arguable. So
sure, yeah. And the company didn't want it. We talked about that last time. They argued against it, or the companies, and ALPA doesn't. They argued against it as well. I could see why, from an economic perspective, the companies, the airlines, I should say, just age 65 to 67 pilots are not the most productive out there. They've got a lot of vacation, a lot of sick time, a lot of disability going on there. So that might be part of what they're thinking. But nonetheless, once things get political.
Yeah. Some of the regionals, I guess they're saying it would help them because less pilots would leave for the majors. What they're thinking. Nice. What else you got?
So another article that a friend of ours sent us was about American Airlines pilots suing the American Airlines 401k. In fact, it says the complaint by American Airlines pilot Brian Spence was filed on June 2nd, 2023 in federal court in Fort Worth, Texas, against American Airlines, its Employee Benefits Committee, Fidelity Investments Institutional, and Financial Engines Advisors. Financial Engines Advisors is the is the entity that allows that American Airlines pilots, and in fact, I think UPS, Delta has the same thing where they can hire them to do the 401k. So what happened was this particular pilot, and he's not the only one, is a little bit angry, I should say, about ESG funds. He's not the only one. We've certainly talked to a lot of people that express their disagreement. However, the idea though that you can sue someone because ESG funds are in his brokerage window, that's where it gets a little bit, to me, a little bit weird and cloudy. In other words, in Fidelity or American Airlines benefits committee, they cannot possibly police every single investment that's available through the brokerage window because everything's available. Yeah. So they would have to simply shut the brokerage window down if they wanted to comply with this guy's request. So it's a little bit, like I said, weird.
Wonky.
Yeah, there you go. And so you kind of get it if it's like one of the core funds in the 401k that let's say you have 12 choices and half of them are ESG funds. Hey, that's a problem, because we don't know yet about ESG funds. If we really just are concerned about, from a fiduciary standard, you have to be concerned about providing the best performance possible to your clients. And so we don't know that about ESG. We can't possibly know that yet. But anyway, so that's a little bit wonky there. So that was an interesting article.
And my guess is if the individual purchased ESG investments, then that's kind of on him.
Yeah, exactly.
Or her to research those and read all the prospectuses and all that kind of stuff.
Yeah, absolutely. You got the choice to do whatever you want. That's the whole. In fact, Schwab calls their brokerage a personal choice retirement account. Yeah. So you have a choice to not buy ESG funds.
Right. Yeah.
But
interesting. Since the last time we talked, we just talked about, all the strike authorization votes being out there. And that day, I think, Charlie, later that day after we recorded, United, came out and said, hey, we're going to have a strike authorization vote. So that's on the docket for those folks coming up soon.
Mm-hmm.
So that's interesting. And then FedEx has an AIP, an agreement in principle, apparently. Yeah. Out there. And the only details I read that were noteworthy here was a news release from the union shared that the details regarding the agreement includes a 30% pay increase and a 30% increase to the pilot's legacy pension.
Wow.
Which sounds pretty good, not knowing all the other details, obviously. So
yeah,
pretty interesting stuff there. We've got, we were going to talk artificial intelligence a little bit here, right?
Let's do it.
So what was interesting is we had Godfather had a question about, will artificial intelligence take over your pilot, your pilot job? And I don't know if AI, directed this at me or what after it heard you, Charlie, but I got this on one of my feeds that the U.S. Air Force trained a drone with artificial intelligence to kill targets. It was all simulated, of course. And instead of attacking, it trained it to go after surface air missile targets. And it did that. And the way they, I guess, programmed it was so it would get points when it went after these SAM sites, right? And so the more SAM sites it killed, after it got approval from the human operator, it got more points simulated, right? Well, the human operator would say, no, we don't want you to go after that SAM site because of whatever reason. And so soon the drone turned on the operator, went after the operator and went and nice. Tried to kill the operator, simulated, of course. And so they said, okay, well, we'll fix that. We'll just say, hey, you can't, it's bad if you kill the operator. You get negative points for that. So the AI drone just figured out, well, okay, my mission is to get the most points possible by killing the most SAMs. So this operator is preventing me from getting the most points. So I'm just going to kill the communication with the operator. And then I'm going to go out and kill all the SAM sites.
So that sounds like a movie.
It's crazy. Reads like a movie. Yeah. So hopefully AI is not taking over my job.
I don't like AI anymore. That's weird.
Like total Skynet stuff, man.
Yeah. That is crazy. The Terminator or something.
Yeah. Yeah. Anyways, questions from the flight deck. You got anything else? Nolan, what do you got on that? Any thoughts on AI?
So That's crazy. I haven't heard a story like that. It's like Charlie said,
Yeah.
that is straight from a movie there.
Yeah.
It's
Yeah, I guess we're all going to be replaced by AI one day. I don't know. We'll see what happens.
Yeah, yeah, no doubt.
Yeah.
Questions from the flight deck, Charlie. You got
Yeah.
anything there?
So we had, I mean, there's been a lot of questions. We won't cover some today. One of the questions maybe we'll cover next time was, hey, in our experience with, our research, working with people, working with lots of different people, what's the best example we've had of wealth building? How have people been successful? We'll cover that next time. That's just like a little nugget to throw out there, right, Rob? That's how we do that.
Yeah.
But the other one that I think we do
Teaser.
have time to teaser. The other one we do have time to cover is got a comment not too long ago, few weeks ago maybe, that said something like, "Hey, I'm going to stop contributing to my 401k, IRA, whatever, because I'm tired of throwing good money after bad. I'm just very frustrated." And we've talked about this before, how these markets have been very frustrating since November of 2021. That was kind of the last high. And it's taken a long time. I think people might just now starting to be getting back to even, possibly, although bonds, that's going to be a while. That was pretty unprecedented in 2022 for bonds. But here's the interesting thing, Rob. I mean, the news is so bad all the time. That's not going to change, but we do have a lot of things going on. It's pretty scary stuff, right?
Yeah.
But while the scary news is out there, the markets have sneakily been doing pretty well. So what I looked at was like, okay, I mean, I get that we're frustrated and we don't want to throw good money after bad, but I looked and I was like, okay, so let's just take a look at the last 6 to 9 months, and I chose the September 29th of last year, 2022, because as of now, that was a low point. We could be at a low point at tomorrow, next week, whatever, but as of now, that was a low point since about September 30th, 2022. The S&P is up about 21.5%. And the diversified portfolio, 80 stock, 20 bonds, is up about 17. And then a 60-40 portfolio is up about, and these are just indexes that I'm quoting here, but is about 14% since, again, September 30th, 2022. So it's just amazing how the bad news just beats us down. And like we talked about a couple podcasts ago, it's hard to stay optimistic. It's easy to go negative, easy to get upset and lose hope and just give up. I'm tired of throwing my money in my 401k and watching it disappear. But all the while we're feeling that way, and the news is giving us all this terrible news. The markets, they're doing pretty well lately. Again, we don't know if that'll continue, but nonetheless, what do you think?
Year to date, S&P 500 is up total return 11.96%. That includes dividends, obviously. But it's something to throwing good money after bad doesn't really mean much to me in this argument, because for Nolan and I, we have long-term horizons, not like gray beard Charlie, but for long-term horizons, it's good. It's actually good that the market's going down, because as we're dollar cost averaging and monthly investing with our whatever NEC or 401ks, there you're getting more when the market goes down, you're buying more shares. If it always goes up, you're buying less shares. So with the same amount of money, 22,500 in your 401k this year, max, for your portion. But yeah, Nolan, what do you got? What do you think?
I'm on your train there. That's great news for me. Buy low, I think that is, it's easier said than done, as Charlie said, about hearing all the bad news, even when things might not be as bad as they seem, but it's kind of tough to drown that out.
For sure. Yeah, no doubt. All right, let's get real for a second. This podcast is brought to you by Leading Edge Financial Planning. And okay, folks, let's get real for another second. What is your purpose in life? I'm asking you to stop and think about it. Maybe even pause the podcast and think about it. The old saying goes, the purpose of life is a life with purpose. I'd rather die for a cause than live a life with that is worthless. And I would argue that this is the first step in your journey toward being intentional. Along the way, Charlie, Nolan, and myself can help guide you down the next steps and help you put your finances to work to achieve your purpose or purposes. You can reach us at 865-240-2292. And Kevin as well, of course. He's extension 1. Charlie's extension 2. I'm down at extension 7. I don't know where Nolan is. What are you, 9? Nolan? Someone.
Yeah, that's right.
Again, 865-240-2292. Okay, enough of that. Are you ready?
I'm ready. Let's do this.
Let's get it. Fight's on. Long-term care.
It's on.
Let's go. I'm super excited. Long-term care.
I love how you lie to yourself there and fake it. And
I do nerd out a little bit. It is pretty interesting because we have so many clients that this is one of their major concerns, right? Is how are they going to care for themselves in the future? So it is not necessarily the most fun topic, but it is very important. So.
That's right. Yeah, we'll get serious now because it is a very serious topic, and it's just a very difficult topic to address. There's no real clear-cut solution for any one. There's no rules of thumb. There's no, and it's just a difficult thing to talk about.
Yeah.
And so that's why we all struggle. And I say we all, and personally, I've thought about it as well. For me, Kevin and I are talking about it today. And in fact, Kevin, what do you have to say about long-term care? You got some opinions on that. All right.
Pause for effect.
Thank you, Kevin. Yeah, thank you, Kevin. That was awesome.
Thank you, Professor. So enlightening. Always words of wisdom.
Amazing,
from the professor. So let's get into a little bit of the details. I hope we didn't cover this. Long-term care. What is it? Who's it right for? What types of long-term insurance are out there? About how much does it cost? We're going to cover these questions, generally speaking, again, because it's so nuanced and so complicated that you really have to dive into the weeds to get a solid plan there. But I think the first point I want to foot stomp is we all believe that long-term planning is for everyone, even if long-term care insurance is not. But planning for the long run is definitely for everyone. So you want to definitely think about that.
Absolutely.
Let's get to some rules of engagement before we get into it too much, Charlie.
Love it.
No prep would be complete without an ROE review, right? I don't think it would. Prodigy, you're probably not familiar with ROEs, but they're rules on the battlefield. So you know when you can engage the enemy and don't go after the operator, and when you can do certain things in war. Savvy?
That's right. So what we'll do today is we're going to just start off.
This isn't NOM. There are rules. Okay? The rule. Now that's a big Lebowski quote, Prodigy. And this should be required watching for all leading edge financial planning.
I know.
Yeah, you're teaching me all kinds of stuff today, Ron.
I know. And I got to confess, I've never seen the movie either.
Oh my gosh.
I know. It's embarrassing.
Well, it's required watching for all leading edge financial planning planners, I believe. But the ROE I wanted to get to, sorry, Charlie, was when we talk long-term care today, we're speaking mainly about the insurance, not just the care so that you can purchase or qualify for. We're talking basically that insurance. Long-term planning is the overall strategy. I like to break it down as we did last time into the goals. There are the objective, the strategy, then the tactics. The goal is obviously to care for yourself or a loved one or a client, obviously, when they can no longer take care of themselves. So that's kind of the goal we're talking about today. And our strategy for this is long-term planning. And then we get to the tactics, which long-term care is in there. So anyway, sorry, go Charlie.
No, I love it. And I'll just, Nolan's going to give us some statistics in a minute, just like what are the typical costs? And they vary like crazy all over the US. It varies depending on your medical situation, but he'll fill us in on a little bit of that. Then we're going to talk about 4 options and I guess those would be the tactics, right? How can we mitigate this risk? Because you can't completely cover this risk. It could be astronomical. We just don't know. But then we're going to talk a little bit about tax benefits possibly or considerations. Are there any VA benefits? I think that's one that I have a hard time, Rob, getting my brain wrapped around because it seems kind of vague. We're going to then finish off real quick just by touching a little bit on what's called Medicaid trusts and who those might be right for and when those are used. But Nolan, what do you think, man? Start us off. What's the typical numbers? What are we looking at?
Yeah, so the comparison of the annual cost of a private room at a nursing home throughout the U.S., it does vary, as you said, by state. So we'll take Tennessee, where you're at, Charlie. $91,000 annually would be the cost of a private nursing home room there. And then buckle up here in California, it's $146,000.
Golly.
New York, thought that was bad. You got New York, 159,000. And then, take a state such as Mississippi, for example, that's 88,000. So even a little cheaper than Tennessee. So as you said, it really varies by state. One of the statistics we have, 70% of people turning age 65 will develop a severe long-term care need throughout their lifetime.
70% of people turning 65 will need something. Is that what you said?
Yes.
That's incredible. That's even higher than I thought.
Yeah, it's pretty amazing. And this is obviously one of the tactics that can be used. The other, obviously, the others that are out there, I think there are 5 solutions. Charlie, Prodigy, let me know if you guys see anything else. But really the solutions are, number one is family member, right? Either spouse, kid, grandkid, other individual, maybe family member, to care for you when you have that long-term care. Obviously, they may not be trained and they may not be equipped to handle some things. The second, obviously, is being self-insured, where you just pay for it out of your pocket, right? We'll get into that, I'm sure, in a second here. But the third one is obviously long-term care insurance that you can pay for. Some or all of your care for. Some folks then qualify for Medicaid, would be the fourth method, but you essentially have to be broke to qualify for that. And the fifth, as you mentioned, Charlie, is the VA, if you're a veteran, and that's something that is not an easy nut to crack.
Yeah, absolutely. And what I'll do is I just want to take real quick. Well, we can take 2 of those options that you talked about. The self-insure is interesting, and the insurance. Clearly that's probably the most common. Yeah. But there are multiple types of insurance. And Rob, what do you want to jump into first? I mean, there's all kinds of stuff here. What do you think?
Yeah, I think the biggest question that most people have is, who is long-term care right for? And we could dive into the definition if we think that's helpful for folks real quick. What do you think, Charlie? Into the definition? Yeah. So this one's from the Medicaid planning site, which is interesting. But the term long-term care, sometimes abbreviated, you'll see it as LTC, can be vague, and many people are uncertain as to exactly what it means. But to begin with, there are specific activities that one must do on a daily basis called activities of daily living. And if you can do 2 of this, if you can't do 2 of the 6, then basically you would qualify for long-term care, not necessarily long-term care insurance. I know Nolan's got some percentages on who qualifies for long-term care insurance, but just because you need it doesn't mean you're going to qualify for it. And sometimes it's too late by the time you need it. So, but those the 6 activities range from like bathing, dressing, grooming, using the toilet, being able to move about, mobility, and transferring yourself out of a bed to a wheelchair or something like that. And those are the activities of daily living. So if you can do 2 of 6, that's what's commonly referred to, I think, as this long-term care need. If you can't do 2 of 6, in very simple terms, long-term care is assistance for persons who can no longer perform these basic day-to-day activities on their own. So it's also, the other part to that is the cognitive part, I believe, which is Alzheimer's, Parkinson's disease, and other types of dementia. So that goes into that.
Yeah, that's good stuff. Yeah, so you cannot do 2 of the 6 activities of daily living. In theory, the doctor then says, okay, you go into a long-term care facility, or you qualify for that long-term care facility, or and then maybe you have insurance, and that's how you got to figure out how to pay for it at that point. So, or like you said, family takes care of you, you self-insure, but yeah. So Rob, I'll just jump in, if it's all right, to the types of insurance. Is that okay to do that?
Let's do it. Yeah.
Now, because this is where, again, other things such as Medicaid trust, Medicaid, VA, we'll talk about that in just a second. But when I think of long-term care insurance and the most common strategies for people to be able to do to cover this or help mitigate this risk, in other words, like those numbers that you mentioned, Nolan, like I don't know, $9,000, $12,000, $15,000 a month. you're not going to buy insurance that covers $10,000 a month. You're probably going to buy insurance that covers $5,000, $6,000, $7,000 maybe a month, just to help that it doesn't completely wipe out your savings. So there are three types of insurance that we think about and that we've seen, and I've had personal experience with all three of them. There is the standard long-term care insurance that we pay for every month. In fact, some of the airlines, Southwest was one that used to have a relationship with Transamerica that offered just a discount, so I think that's gone away. I think Transamerica is out of the business altogether. But anyway, so you could just pay per month, depending on your age, your medical needs, you pay per month forever. And if you need the insurance, you get it. If you don't ever end up in a long-term care facility, then you pretty much don't get the money back, the premiums that you paid. I say pretty much because there are return of premium programs. It's going to cost you extra. It's not going to return 100% of your premiums. Again, this is where the complexity enters in, but that's the first one. Just basic long-term care insurance. You pay by month for the rest of your life, and that's option number one. Any thoughts on or experiences on that, Rob or Nolan?
Go ahead, Nolan.
I don't have any on that.
Yeah, I think it's just a foot stomper that, to your point, Charlie, and we're going to get even more complicated here. We'll try to keep it simple, but long-term care can be very difficult to cover, very tough. Even if you kind of know what you're doing. I think this is, to this point, there are now specialists that they call, or have named themselves placement professionals, that you can hire to maybe help recommend and find the right place for you to get into. That's not necessarily dealing with the insurance, just finding the actual facilities that you can get into. And I think they take into account what kind of insurance you have or your needs and your financial situation. So very difficult topic.
Yeah,
really.
And the just a couple pros and cons, and I'm just going to call this standard life long-term care insurance because that's kind of the most common, I believe. But a couple pros and cons here in that it's it's, as far as the other two, especially the life insurance one, this one tends to be less expensive. If you do the math, the other ones you got to pay some lump sum and a lot more upfront. But that's debatable, and it depends on what kind of policy you get. Some of the cons here, the things that are not so good, is that people don't like the idea of paying premiums forever and possibly not using the insurance. That just doesn't sit well with people, even though that's kind of the way term life insurance is. Homeowners life insurance is the same way. People just don't like that idea. And I understand that. So that's a little bit of a drawback. The other drawback, or drawbacks, I should say, is that it is the most stringent on medical screening. So if you're overweight, whatever that definition might be, or there's something in your medical records, when I say something, I mean something small could show up, and you could be relatively healthy, and it disqualifies you for this long-term care insurance. A history of Alzheimer's in your family, like you talked about, Rob. So it's pretty strict. The other thing that we've seen that people don't like is once you start to get 75, 80, 85, during those years especially, your premiums are going to go up significantly. And now the insurance companies are not allowed to increase your premiums personally. Like, Rob, your insurance premium's going up. No, they can't do that. But what they do is they say, Rob, your age group, your class, your premium is going to go up 20% this year. And so we do a lot where we get these policies with our clients and we go, okay, the premium is going to go up 20%. Do we need the coverage? What are the options? What about family? What about if we dumb down the benefits, reduce the benefits? Can we still afford it? And is it still worth it? So that's a little frustrating, to be 80, 75, 80, 85, and all of a sudden every year you're analyzing whether the policy is still affordable, still worth it, because the premiums go up significantly. So that's a little frustrating.
Yeah. And then, the insurance folks get in there, and there's all kinds of different rules. You got to be very, very careful if you do sign up for it. I think sometimes you might be able to get a rider where it locks it in, but I think that's very rare, and you're going to pay it through the teeth to get it probably. But
it is, absolutely. That's the first one. The second one, and I'll just be a lot more brief about this one because I think it's simpler, but it's an annuity where you can purchase annuity if you're in retirement, and then if you have like you said, Rob, one of those or two of the 6 ADLs, you qualify for the long-term care, then your annuity payout doubles. Let's say it doubles for 3 years or 5 years, whatever you decide, whatever you purchased. Obviously, there's a cost there, but that might work for someone that kind of wants an annuity anyway, and they stick this rider on there. And then again, if you have a situation, your $3,000 a month annuity could turn into a $6,000 a month annuity payout that might help while you're in a long-term care facility. So that's the annuity one. Maybe the least popular of the three, but I'm not positive on that. The third one is the third type of insurance is the hybrid life insurance policies. And these are usually a whole life policy, maybe a universal life policy where a couple, let's say, buys life insurance, and then it's a permanent life insurance. So you're going to pay this thing. You can pay either in one lump sum. It's going to be probably upwards of $100,000, between $100,000 to $200,000. You're going to pay either in a lump sum. You're going to pay over 10 years, or you could pay it over your lifetime. And so now you have a life insurance policy that has a death benefit. So if you pass away, your children inherit the death benefit, or your spouse. But if you go into a long-term care facility, then it's going to pay out a certain amount every month, and then that probably would use up the death benefit. So you're either going to have a death benefit or long-term care benefit, and people tend to like that a little more because they're like, well, if I don't use it, my spouse or my children will get the funds. So that seems to be a little bit more popular, I would guess.
Yeah. It's such a tough nut to crack because you start mixing, annuity, life insurance, long-term care. Sometimes it gets a little messy in there. So it's important to sit down and think about it. One of the questions that obviously we get used is, who is long-term care insurance? Just, not necessarily getting the annuities or the life insurance products there. All together, all of those together. Who's it right for, Charlie? Who's someone we'd say, hey, you should consider, or this couple should consider long-term care insurance?
Yeah, that's a great question. And Nolan, did you find anything in your research as far as ages or anything like that stick out?
Women are typically in nursing facilities longer. I think it's about 3.5 years, and for men it's 2 years. I did read something where the man, if they're going to self-insure, what can sometimes happen is the husband might spend it all on him because he might get into long-term care first. And that's like, what's the wife do, kind of get the bad end of the stick. So I thought that was an interesting point if you self-insure.
Yeah. I think from the planning perspective too, we start to really talk seriously about long-term care in the late 50s, early 60s. And that's no exact, somebody else, Rob, you might have a different thought on that as far as the age and the right time to start planning. An insurance person that sells long-term care is going to say the earlier the better. And there's an argument, a little bit conflicted possibly, but they're going to say if you buy it earlier when you're healthy, it's cheaper, and you're going to be more likely to qualify medically, which both of those things are true. The cheaper one you could argue with, because if you look at a normal life expectancy, you're paying a premium for a long time, et cetera, et cetera. So there's no exact science. You could get 10 different answers from 10 different people, but I think we generally believe 55 to early 60s, mid 60s might start to get a little long in the tooth because premiums really start to go up. Health starts to become more questionable as far as disqualifying you from one of these types of policies. By the way, the life insurance, I didn't mention it, the life insurance hybrid or the annuity are much less stringent on health screening. In fact, we've had people to apply for standard long-term care insurance, didn't qualify, and then we're like, well, let's go to try the life insurance route, because it was something that appealed to them and they did qualify. So that's a huge point, Charlie. Yeah.
I think that's huge. Yeah.
Mm-hmm. Yeah.
Because I think this may not be the exact statistic, Prodigy, you probably know better than I, and we'll throw it in the show notes if we find it here, but I think it's like 45% of people who apply for just the straight long-term care insurance don't qualify for it.
Mm-hmm.
I think it's pretty high.
It is. Yeah. They're pretty picky because the insurance companies have lost big time, because these long-term care facilities are so expensive.
It's crazy. I was, doing the pre-show prep there. It's something like there used to be, in the early 90s, 2000s, there's like 130 companies that did this, and it's been whittled down to about 13.
Yes.
Now, that's not to scare you. If you have a contract with an insurance company, I think for the most part, we're not lawyers here, but I did sleep at a Holiday Inn the other night. You are protected if you have a contract with them, as long as you keep paying the premiums, and that company's in business, you're protected. Even if they go out of business, I think they have insurance to cover you on your policy. So not to scare you away, but it has whittled down, and the costs have obviously gone up, and the costs will probably continue to go up as we age longer and maybe, find better ways to live longer.
That's right.
Refer to our, what was it? Flight 58.
58.
Health and wealth.
That's right. And that's so true, Rob. I mean, we joke and laugh a little bit, but man, we've got more control over this than we think. And I'll just tell a quick story about my own family. My mom and my stepdad there. That was, they recently retired a couple of years ago, and everything, they're set and they're well on their way. But it was the one risk was this long-term care risk. We just didn't have it covered. And we went back and forth on different types of things. I mean, we looked at this for years. When you're working with family, you want to get it right as much as possible. But it was just one of those things that didn't quite feel right, leaving it uncovered, leaving that risk there. It's like, man, we got to do something. So that's oftentimes the solution, is to do, something is better than nothing sometimes. But we ended up, I'll tell you for them, we ended up doing a hybrid life insurance type situation. It just worked out best for their situation. Other people we've had that preferred an annuity. It worked better for them. And then we have a lot of folks that have standard long-term care, which is great. I will transition though into back to your question, Rob, like who and what and when, but we talked about the ages where we really want to start focusing and thinking seriously about solving this, mitigating this risk. But the other part there is, I think, based on someone's wealth. And when I say wealth, I mean a combination of spending, net worth, savings, because in general, this is a super broad statement, which I can't even hesitate to make, but no,
you got to do it. I love it.
I got to do it. Yes. About like 700 grand, let's say 500,000 to a few million. That's
exactly what I had, Charlie.
Yeah, that's right.
To 3 million. Yep.
That's right. That is where you really need to be thinking about it. And again, let me clarify a little more. Once you surpass a few million, and the spending is a big part of this, because if you got a few million going into retirement, but you're spending $20,000 a month in retirement, you need long-term care insurance. You're spending too much money, possibly depending on other sources, whatever. Yes. So the spending is a big part of the equation, but in general, that window that we talked about, you really need to consider long-term care solutions as far as insurance, or like you said, family. And once you get on the other side of that 3 million and ish, and your spending is reasonable, then you might be able to self-fund this problem. And we do that. We make that planning. We include that planning, I should say, in the retirement planning process. We put a scenario in there like, okay, Bill, let's pretend you're 80 and you go into a long-term care facility for about 3 years, because Nolan, you just said the average male is about 2.2 years. The average female is closer to 5. So we put it in there. We go, okay, what would this do to your wealth? Because we don't want a long-term care situation to destroy someone's legacy, their wealth. But if they could fund it, then that might be a good option for them. They might be comfortable with that. And I know we're walking on thin ice here as far as making recommendations and these broad rules of
these are
thumbs.
not recommendations. Yes.
Yeah, that's a big deal. We don't want people taking action on these because it's very nuanced. But
so nuanced.
Yeah.
I'm glad you brought up family there,
Mhm.
Charlie, because you
Mhm.
really need to, it's so individualized. You kind of
Yeah.
asked, when do we start thinking about it? And it's
Mhm.
so personalized up to the individual or the family or the couple. You need to sit down with your family, really know what they think about you growing old or a loved one growing old, and how you're going to cover that. The longer you wait, the more chance you might not
Mhm.
qualify, as we talked about. So age is definitely a consideration. And as we talk about through our planning process, what are your goals? What are your fears that we want to help
Mhm.
mitigate the
Yeah.
risk of? So if you're super, if it's debilitating to you to sleep at night because you're afraid of what's going to happen because you had a family event maybe
Mhm.
where a loved one had a bad long-term care experience, then I think, if you believe in insurance, it's a way to go even earlier
Mhm.
than those dates if it's something that's important to you. So going
Absolutely.
after, again, circling back to values. But I think of the 500,000 to 3 million. If you have $3 million, and like you said, if you're outspending, then that's a problem. But for the most part, you probably made
Mhm.
$3 million because you were watching your money, and we can
Mhm.
probably find a way to pay for long-term care. Generally speaking,
Yeah.
inside that account somewhere, there's probably enough money. Again, somewhere around $100,000 a year. Long-term care, I think the average for people who apply for it is about 2.8 years. Not about, it's
Mhm.
2.8 years. So right around 3 years, 2 to 3 years. Probably for men, it's a little less. So maybe men are about two something, and
Mhm.
women may be a little longer. So something to think about there. And the 500,000 to 3 million, that's for couples, is
Mhm.
is what we're talking about there. So some other things to think about is your marital status. Obviously, if you're single, you're more likely to buy long-term care insurance, but depends on your family and friend situation and really
Mhm.
getting to know those things, which kind of brings up another point, which is there are what we call the activities of daily living. And then there's another term that the industry uses called instrumental activities of daily living. And I won't get into those, but those are
Mhm.
IADLs. I'll touch on them just a quick second. That's like driving to the movies, getting your nails done, doing
Mhm.
those things, dealing with bills, financial planning, right? Doing your finances, doing some of these things. Long-term care will probably not cover those things,
Mhm.
right? So even if you have long-term care insurance, you still are going to need to be thinking about some of these
Yeah.
things before you get to a point where you can't think about them. So uh, it's important to sit down, think about your lifestyle. Are you healthy? Are you trying to do exercise habits? Are you a smoker? Some of those things.
Mhm.
Family history, of course. And if you get into a point where you don't qualify, I love what Charlie said. The hybrid life insurance, maybe
Mhm.
you can qualify there to cover your risk. But then you get into the other things like, hey, let's sit down and talk to your family. Self insure. I
Mhm.
think I saw somewhere that the average of once you get on, somewhere in the $300,000 range. So if you have $300,000 that
Mhm.
you can put towards this, maybe you don't get into a situation where you outlive your money. But there's always the plan too that some people have gone on to, and I think we were going to touch on this just quickly. Was you can combine these plans or these strategies or these tactics, right? That okay, you're self-insured until you run out of money, and then you
Mhm.
qualify for Medicaid. Now, the tricky part of that is Medicaid. So a lot of facilities don't take Medicaid, and
Yeah.
even if they do take Medicaid, they have to be able to care for you. So even if they take Medicaid, you run out of money, and now you're in a pretty tough situation, or your situation is such that they can't care for you. Then you got to find another facility, anyways. So
Yeah. Yeah.
um,
That's a great transition to the next couple things is Medicaid. And I'll talk real briefly on the VA. What does the VA do? We have a lot of military people,
yeah,
like, you, Rob, and I was in the military, of course. And what does the VA do? But real quick, Medicaid, back up even further, Medicare does not cover long-term care. And what will happen is this: most of the time, a situation occurs where an older person is injured, they fall, they have a stroke, and they go into the hospital. They do get coverage for I think it's 100 days on Medicare, in a long-term care or post-injury recovery facility, whatever we call it.
Rehab, yeah.
Rehab, yeah. 100 days is all that Medicare is going to pay for. They're not going to pay for long-term care insurance. So that's often misunderstood.
Let me jump in here, Charlie, because this is an important point too. Just having dealt with this myself a few times, not for me, but dealing with it. Medicare pays for 100 days of rehab if you spent 3 nights in the hospital. So you got to get 3 nights. But then even then, don't think you're going to get 100 days in a rehab facility, because about day 12, the facility is going to evaluate and see if you're improving or not. If you're not improving, they're going to kick you out at 12 days.
Wow.
So don't plan on 100 days in a rehab facility unless you're making steady progress. So that's part of Medicare Part A if you're on that.
That's interesting, because you could, if you're not improving, then clearly you need more help, and boom, now you're on your own. So I didn't know that.
Yeah.
Medicaid is interesting because a lot of people, I'll just use Medicaid, but let me read this real quick. It's and Medicaid is administered by the states, and they determine their own Medicaid eligibility, and they may vary in a variety of ways. In most, though, the annual income limit is $29,160 or less. This cap includes Social Security and pension benefits, as well as wages and investment income. Financial resources such as bank accounts, investments, revocable trusts, that's a key phrase, revocable trusts, because we'll talk about the opposite in a minute, and real estate typically cannot total more than $2,000. So you are absolutely broke if you're going into a Medicaid facility, and they're paying the bill. Not to mention, Medicaid facilities are, how do we say this, a little rougher, maybe? Less than desirable, perfect. AKA they smell like urine when you walk in the front door. Let's just throw it out there. So that's what I've heard. Anyway, and if Medicaid is footing the bill, they also have the right post-death to go back and recoup assets, possibly homes, et cetera, from the inheritor or the children in this case. So that's interesting. Real quick though, I'll jump from Medicaid to the VA. And I've looked many times over the years, talked to a lot of people about VA. What the heck does it cover? The best I can tell, and Rob, you can add on to this, is that it may or may not cover long-term care. That clears the mud, doesn't it? It clears mud. But basically what I've learned is this. If you served in a certain war at a certain time, let's say Vietnam, I think if you were in Vietnam during a certain time and then you have a long-term care need, I think it will pay. But let's say you were in 1980 from 1988, nothing going on, possibly. It's probably something there like Grenada or something, I don't know, but you may not get anything. I think if you're also of Medicaid qualifications, i.e. you don't have anything left, I think VA would then kick in. But let me read it real quick. It says, this is straight from the VA's website. Medicaid and other funding sources cover the cost of some long-term care services and settings, depending on eligibility. Many people need to use their own income or savings to pay part of the cost for long-term care services or settings that they need or prefer. So they're saying it may cover some, may not. You need your own. So I don't know that we can rely on VA benefits as a planning tool. Rob, anything to add to that?
No, the big foot stompers are your disability ranking definitely factors in, but you really have to apply through the VA, and they're going to figure out if you qualify for whatever facility you're trying to get into. They have an aid and attendance plan, which is a little bit different than I think the nursing home facilities. And that's where if you're almost not quite on welfare, but just above it, you could qualify for that. But the other part to this is they have to have a bed available. So it's almost like a first come, first serve if you qualify, and they do their rack and stack, if you will, of patients getting in. But there could be a wait list for years. And obviously if the average time is 2 to 3 years, it might be too late on a lot of those things. So you might have to fund it yourself. But some of the places out there, that if you can get into them, they're going to cover a lot of things for you. But you need to have enrolled in the VA, beginning VA healthcare, I believe, as well. to handle. Definitely something to look at if you're a veteran, but planning on it as one of your hard and fast rules is probably not something you're going to do, because if you have the money, you're going to likely want to take care of that and procure it other way.
Yeah, I would tend to agree. If you've got the funding, they probably are not going to step in unless it's like a military injury that caused you to go into long-term care, possibly. I don't even know. It's very vague on their site. But the last thing I'll say is that I know that we can give away things. Like I mentioned there, the revocable trust. So most people know that if I just gave everything away to my children, then I might be able to qualify for Medicaid. But there's a 5-year look back. So what happens is there's a thing called Medicaid trusts. So you have two options, and I went to a presentation last week, Nolan, when we were at our conference in Vegas. Seriously, it was a financial conference in Vegas, not a cover story, not a boondoggle. But anyway, it was an attorney from New York, and she gave an outstanding presentation on should you give away your assets to qualify for Medicaid. And basically the two choices there, you can give away your assets to your children, which she said 99.9% of the time you should not do. Okay, that's from an attorney in New York. States vary wildly. But she did say putting your assets in an irrevocable trust could be a good option. And irrevocable means you don't own them anymore. You essentially have given those things away. So there's a lot of implications there. Is if I give something away, I lose my post-death step-up in basis, possibly. If I sell a home, then I lose the tax exclusion. So there's a lot of considerations there. Again, this goes back to it's not only is it different from state to state, Rob, Nolan, it's different from county to county. So you have to have an attorney to do this stuff, but it could save you a lot if it fits your situation. So this attorney in particular from New York said, we typically help people put their assets in an irrevocable trust. And then once they meet that 5-year look back, they qualify for Medicaid, therefore at least preserving their assets for the next generation. So that is one option we wanted to throw out there amongst all the other options we've talked about. This last thing I'll say is that Kevin and I were talking about this today, like how the heck do you solve for this problem? And I said, Kevin, it's like the family with 6 children that's planning for college. You do a little bit of everything you possibly can do to mitigate the risk as best you know how. And there's no one thing that's going to just really nail this thing down and cover it. You know, you've really got to kind of look at all the options and decide what's best for your circumstances and families.
Yeah, I think that's so important. You brought up this different state to state, not just in that Medicaid example, but the states cover Medicaid. I think they're on the hook for. So some states like Washington State has a tax, I believe that's going into effect, where if you don't have long-term care insurance already, if you do, you can say, hey, I've got long-term care insurance, don't tax me. But if you don't, they're going to tax it. And that's how they're going to get, I think they're going to get like $1 billion a year to help pay for these long-term care Medicaid facilities. So that's something to think about. And then you might have, if you live in that state, you might have above and beyond the regular Medicaid. I'm not exactly sure, but it's state to state specific. So dive into that if you live in one of those states, and be aware, do some Google searches. The other thing I want to cover real quick is long-term care insurance costs. Just generally speaking, we're recording this in 2023. If you're a couple in your 40s, it's about $3,000 a year ish. Couples in your 50s, it goes up to about $5,000 a year. In your 60s, up to about $6,000 a year. So it can be something you can cover. Not cheap, but if it's one of your values, you want to make sure it's in there. You can cover it. The other thing is some of these long-term care plans, it's more expensive to stay in the home, but the VA will help maybe more with that if you stay in your house and help you with some of the care. But I think it's just like Charlie said, you're going to have to look at several different tactics and put them together to come up with a good strategy. But you need to do it. Otherwise, your family's going to be left, holding the bag.
Yeah. Don't stick your head in the sand on this one. At least talk about it. And Nolan, what do you have for us on the tax front there? You got some tax information. Anything interesting there?
That's right. Yeah, I would say a frequently asked question, I'm sure, is whether the long-term care premiums are tax deductible, and they are. So as long as the premiums you pay exceed 7.5% of your adjusted gross income, then you're good. For self-employed people, the rules can be a little different. So the premium can be taken out as a tax deduction as long as they've made a net profit for the year. I do think it's interesting because only after retirement are people likely to reap the benefits of these deductions in some ways, because it really goes up quite a bit with the IRS levels. By the time you're over 70, you could be able to deduct almost $12,000 from your long-term care premiums. And so we'll include a chart I have here of your age and the 2023 limit, and we'll put that in the show notes. And of course, a health savings account, I think that was another one, Charlie, we had mentioned. So you can use that money from the HSA to pay premiums as long as it's an eligible long-term care insurance policy. But the amount you withdraw is tax-free based on your age. So the older you are, the more you can withdraw tax-free.
I love it. I love it. Just to throw in there too, a lot of people talk, can I get it and pay for this through my IRA? And this one comes from elderlawanswers.com, which is the law folks there. If you invest in a tax qualified annuity that makes internal distributions to an insurance carrier, I think that's what you were talking about a little bit, Charlie, or one of them perhaps, you can indirectly pay for long-term care coverage using IRA money without additional tax penalties. But again, that's a combined product there. Good stuff. What do you guys got? Anything else?
That's it, man. I'm
tapped. I'm done.
That's it. Tapping out.
Hey, last little bit. If you're above the 3 million and you're self-insuring, one of the facilities you might look at, you have to pay a lot of money. I think your family gets it back when you pass, but it's called a continuing care retirement facility. Think of it as like a stationary cruise ship. Has all these kinds of things, foods, a big pickleball court, all kinds of activities and programs and ways to help you when you get into that long-term care, which your long-term care I think can help pay for. Obviously depending on all that, but helps you age in place. That's like kind of the gold standard if you got the money for it, is my understanding. That's it. Couple of quotes, brief quotes for you to ponder on your drive or flight or morning, afternoon ritual, whatever you may be doing. This one's for my wife. Grow old along with me. The best is yet to be, the last of life, for which the first was made. Our times are in his hand, who saith, a whole I planned, youth shows but half. Trust God, see all, nor be afraid. Robert Browning, that was obviously an English poet. I should have said it with an English accent, but I didn't. The second one is also from an American poet this time, Theodore Roethke, I think is how you say it. How body from spirit slowly does unwind until we are pure spirit at the end. I'll say that one more time. How body from spirit slowly does unwind until we are pure spirit at the end. That's it. Let us be the first to welcome you to the final destination of Flight 59, long-term planning and care. Did you learn anything from this free podcast? If so, pay it forward and tell someone about it and leave us a review. We aim to make the world better stewards of their money. Help us do this. Please shoot us any questions you'd like us to cover on our next Questions from the Flight Deck. And remember, as Emerson said, the world makes way for those who know where they are going. And as I say, so plan accordingly. From all of us at the Pilot Money Guys, we optimistically wish you smooth rides and soft in the zone landings.
Leading Edge Financial Planning, LLC is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Leading Edge Financial Planning and its representatives are properly licensed or exempt from licensure. For additional information, please visit our website at www.leadingedgeplanning.com. The information provided is for educational and informational purposes only and does not constitute investment advice, and it should not be relied on as such. It should not be considered a solicitation to buy or an offer to sell a security. It does not take into account any investor's particular investment objectives, strategies, tax status, or investment horizon. You should consult your attorney or tax advisor. The views expressed in this commentary are subject to change based on market and other conditions. These documents may contain certain statements that may be deemed forward-looking statements. Please note that any such statements are not guarantees of any future performance, and actual results or developments may differ materially from those projected. Any projections, market outlooks, or estimates are based upon certain assumptions and should not be construed as indicative of actual events that will occur. All information has been obtained from sources believed to be reliable, but its accuracy is not guaranteed. There is no representation or warranty as to the current accuracy, reliability, or completeness of, nor liability for, decisions based on such information. and it should not be relied on as such.